Welcome to the Money Runner. I'm David Nelson, your host. We're going to try something a little different today. As you can see, I'm here in the Belpointe studio in Stamford, Connecticut. We're going to bring in, one of our top advisory firms in the Belpointe ecosystem. In just a moment, I'm going to bring in Rusty Cagle, CEO of ASE Private Wealth. Let me tell you a little bit about Rusty before I bring him onto the show. First off, Rusty, in addition to being an accomplished CEO and financial professional, he is, of course, a noted media personality in his own right. He's authored or co-authored the book Empathy and Understanding Business, and is featured in the highly anticipated TV show coming out this fall. That's right, spotlighting business leaders reshaping the future of wealth. First, Rusty, let me bring you into the show real quick here. First, thanks so much for coming on today. I was reading, your bio, and, we all have, symbols or letters at the end of our name. I've got a couple. You have so many. I don't know where I've seen that many. Just let me read off a couple of these things. MS, MPAS, CFP, CAP, CEPA. The CAP, I noticed that. Well, what does that stand for?
That's a charter advisor of philanthropy. So a lot of the stuff that we do for our clients are philanthropic. So that's a charter advisor of philanthropy. And David, I will tell you, I have a lot of continuing ed that I had to keep up with all these designations. That's for sure.
I'm sure, but I have a CAP as well, but it's something completely different. I'm in Civil Air Patrol, so it has nothing to do with finance. Let me just kick it off with what we've seen this week. Kind of an important week. Some of the big companies have been reporting. We had Alphabet last week, which was a great number. We had last night, Microsoft and Meta were just outstanding. But the one thing we're learning from all this is, so much of our economy is being driven by artificial intelligence, which is really a word that we weren't even using a couple of years ago. What are you seeing in your neck of the woods? Are people talking about it? Are they excited about it, or are they concerned about it?
That's a great question, David. I'm part of a AI 100 CEO collective where privately held business owners and CEOs are looking at AI and how we can be on the front edge of that curve. But however, I'm finding with a lot of our business owners that we work with, and even a lot of our family offices, they're still not really adapting to AI, right? It's still very foreign to them. And as we continue to see, and I heard on the reports this morning, some of the Magnificent Seven just continue to put money in and invest in that. We know that's where the future is going. But it seems like from the privately held business held sector, there's just not as fast of an adoption there. So
it is going to be important. And I would encourage everybody out there to look at it, experiment with it at home so that you can start to understand it. I know I'm using it in my business. You're probably using it in yours. I found it has made me more efficient. It's earnings season right now, and there isn't a day where I don't have 4 or 5 companies reporting. Sometimes it would take me a couple of days to analyze all those reports. So with the help of artificial intelligence, they can be examining the conference calls, the spreadsheets, and I'm sure you're doing much the same. But one of the things that seems to keep coming up on the economy is this build out. We seem to be spending a lot of money on it, and I guess, what's your perception on, is it a good thing for the economy? Is it going to suck money into the wrong places? I guess what I'm asking, do you view it as a net positive?
I think I view it as unknown, right? I mean, again, I'm old enough to remember when we started getting into the internet in 2000, right? And maybe planes falling from the sky with the fear of what was happening from that standpoint. But I think is some of the things I've researched, you see this adoption curve at any part of technology in history. This is going faster than anything. And I think those who embrace it are going to be able to stay ahead of the game, those who don't, and there's still a lot of uncertainty. I think a lot of people think it might replace their jobs or it may be taking away those things. And I think if we just look at it in a way that it can enhance and it continue to help us get better, I think it is going to be a benefit to the economy. But you're right, there's massive amounts of money being spent. It's going to take massive amounts of energy to be able to drive all of these initiatives in there. And so I think the unknown is just causing a lot of people to just be uncertain. And usually when you're uncertain, you kind of sit back and just wait to see what happens, right? And I think that we're seeing a lot of that in the privately held sector. And so I think a lot of the public companies who are pouring money into it are going to get ahead. And that in itself could have some implications on the private sector, right?
I think you hit on maybe the most important point, the amount of money being spent. I'm going to bring up a chart real quick, and I'm going to skip around here and go to something a little different. This was Microsoft's CapEx chart, what you're looking at right there. And what you're seeing, that's like a 5-year period of time. It goes back to 2022 over here, and it's projecting out to a couple of years from now, 2027. And what's interesting here, if you look at the amount of money that they're spending to run their business, now granted they're a growing company even without AI, their capital expenditures, the amount of money they're spending would be going up every year. But I doubt it would have gone up 365%, over that time frame. Yeah. And you start to translate that out to a lot of other companies. This was Meta last night. And their numbers came out. This is the same period of time, 500% increase. Now, my guess is over a 5-year period of time, maybe their capital expenditures would increase 50, 60% if they're really growing, not 500%.
You've been seeing this a long time, right? Have you ever seen the magnitude of this type of CapEx forecasted in the future, right?
It dwarfs anything I've ever seen in my career. Even the internet wasn't anything as big as this. One of the other things that came out, and I wanted to, grab your take on this, was this chart here. This is just data center expenditure and what's likely to happen over the next 5 years. And what we're finding is, of all the money that is spent on data centers around the country over the next 5 years, 3/4 of every dollar, 77% of all dollars spent will be on AI-specific applications. And that little sliver in blue there is everything else. So those are big numbers, and it's certainly good for technology. Maybe it's good for semiconductor stocks, but what does that mean for Main Street? Are they going to be the net beneficiary of this?
Well, for you and I, probably remember the Pac-Man game, right? Where the Pac-Man starts eating everything up. If you look at this, it looks just like the Pac-Man figure, right? Where it's just chomping everything. And if you see this, it's these are data centers, right? So there's security around it. There's electricity. There's all of these different things that's got to go into this same type of infrastructure here that's just building on this. So you can see the massive amount of bets that is going into this, that it is going to be totally transformational on the way that we do things. Even in the CEO leadership group that I'm in, literally every 60 to 90 days, there's a new platform, there's a new agent, there's new ways of doing things that build on top of each other. Being able to take financials and looking at them and scrubbing them in different ways. So the massive amounts of way that we can look at data is truly going to change our whole landscape. And I think it can be a good thing, but it also can be a scary thing also, right? And I think that's a lot of what Main Street, our clients, business owners, they're looking at this. And I think there's almost a tipping point with a lot of our clients that may be a little bit older and have a business. They either have to decide they're going to either adopt AI and how it can help them compete, or they're potentially going to be left behind. And I think sometimes it's really hard to evaluate how they should go about doing that. That's the biggest thing that when I'm talking to other CEOs, other business owners, the right way to go about approaching this. And I think that's the confusion side on the Main Street side, where it looks like in the public markets, they're going all in on this, right? And there's just this huge gap between the two.
I think, we all get calls from, sometimes it's even family. What do you think of this? And I guess the truth rarely lives on the extreme. It's usually it's usually not all good, and it's often not all bad. But somewhere in the middle is the truth. And I suspect what'll actually happen is we're going to have tasks. Some of the tasks that we do will probably be replaced, in much the same way. The Industrial Revolution in the early 1900s. People started doing different things. So some of I find already some of the things that I used to do on a day in, day out basis, I'm turning that over to a large language model like ChatGPT or Grok. But if I adopt this right and I do this correctly, I'm not going to put myself out of work. I'm going to be able to expand the amount that I do. Will some people move to different jobs? That's probably true. To say that the glass is, it's a very rosy picture. It's not going to be rosy for everybody. We know it's going to be disruptive and change. One of the things I try to fight back on, and I wanted to get your take on this, is when people see this kind of investment cycle, they tend to want to go all in on it. And they want every investment dollar in the highest potential return. And they start to lose sight of the old-fashioned balanced portfolio. What are you telling your clients at this moment in time?
I think that's a great point. There was a research article that came out by Gartner. They do a lot of research on technology and different companies along those lines, and said that by 2027, 60% of all AI that's out now will be of non-value, because right now it is so much hype, there's so much money being spent, and yet just in 2 years, 60% of it will be worthless. So as we're advising clients, we're looking at this, look at the companies who are some of the leaders in putting money into this and can change the game, but also don't get caught up in such a hype cycle that it could cause us to be overweighted in something along those lines, really. And a lot of times, if we're younger, we can take more risks, but a lot of our clients, they're have more established, they have wealth, and so a lot of times we're trying to make sure that we're preserving that wealth, but looking for opportunities where we can maybe get a higher value on some of these type of things, but not go overextended, right? You just don't want to go all in and go out. If you try to time the market, you got to be right twice. And
let's talk about that word. You just used a very important word, risk. And we had a wake-up call in April, yes, where we had a new risk. Suddenly, we were talking about tariffs. And we had a vague idea what tariffs were going to do, but then we saw what happened to the market. It was pretty significant and pretty fearful. And people started really rethinking the risk bucket that they were in. What do you tell your clients? Because there's two extremes. There's right now, price solves a lot of problems. Yes. And everybody's attitude changes, when prices are going up. What do you tell them about the risk tolerance? I've always thought that if the risk tolerance should match both the bear market and the bull market.
Correct.
And how do you rein people in and keep them in a risk tolerance that is the right thing, one that they can handle, and it's also the right thing for their future?
Yeah, and that's a great point. At our firm, we have it's the wealth sustainability model, right? So we look at 1 to 3 years and making sure we have enough cash equivalents to, if anything happens in the market, we're not going to be hurt significantly. Then you have the 4 to 6 where you have some up and downside protection, but the 7+ is really where, all right, if we need to have some long-term money, where does it need to be? And I help people to think it wasn't too long ago when we had COVID, right? And we had these drastic downturns, and it happened with a 4 to 6 week period, and we didn't know what was going to happen, maybe very similar to now. And then we saw that come back up. So you mentioned earlier, we never want to be on the tips of the extremes, right? So if we're panicking when it's down or we're exuberant when it goes up, that's not a way to make money. That is a surefire way to lose money. And so if we're getting emotional like that, then we will never be able to preserve some of the wealth we have. So sometimes you tilt a little bit based on certain things. And if you have maybe some excess money in the 1 to 3 year bucket that we see a big downturn, we see that as a buying opportunity. So we put money over there, but we also want to make sure that we're being very fundamental in our approach, no matter what extremes we see in the market. And you make a great point. April, everything was down. We're going into a recession. We don't know what tariffs are going to do. Now we're at the other extreme, right? The market's at an all-time high. We're inflation low. All right, now let's put more money in. So you can't get caught up in all of the either doom and gloom or the exuberance of the market.
That's great advice. And, we tend to forget it, especially when the markets are at highs. We start to think, you know what, I can handle a little more risk. And then something comes, and it's usually something we haven't even anticipated. It comes from out of the blue. But one thing that always seems to, kind of rule where markets are going is interest rates and what's happening at the Federal Reserve.
Yes.
Let me pull up a chart real quick because I did want to talk about it. We had a Fed decision. This week. Of course, nobody was expecting anything to happen yesterday, but we know about the soap opera that's going on between the administration and Jay Powell. The president wants him out. Jay intends to stick with his term, but there was a new wrinkle here in this. I'm going to talk about it in a second, but right now, so many of us were looking for an interest rate cut, maybe as early as September. This shows right here. I took this snapshot the day before yesterday, the day before the press conference. It was about maybe a 68% probability of a cut in September. Now here we are, today, and it's dropped to 42%, and so less likely. But one of the things that came out of that call was there was some dissension, and what. One of our interns here pulled this up. It was very interesting. It was a history of the Federal Reserve going back to 1980, talking about, the number of times a Fed governor dissented with the chair, in this case, Jay Powell. There were 2. It was first time that many in, probably 15, 20 years. How important is the interest rate cycle for your business owners? What are they telling you with how business is for them, and how much of a drag is these higher rates on them getting their business done?
It impacts a lot. In the mergers and acquisition side, a lot of the deal flow has gone down, right? It's a combination of interest rates being higher, tariffs. You have uncertainty there. And whenever you have uncertainty, especially in the M&A market, then deals tend to get retraded. You have different types of earnouts that you would have to have. And so for a lot of our private health business owners, and if they're looking to either do a recapitalization or if they're looking at projects that they're wanting to invest money in, we may not really think about it, but a couple of quarter points or 50 basis points can mean millions and millions of dollars on deals, on projects. And when you start talking about that magnitude, it is a really, really big deal, especially with Main Street businesses out there. So it's definitely a big impact. I would say on our side, we tend to want to see a little bit of the pressure come down on interest rates, which would spur on more economic spending and us taking more risk on things that we're doing. So it has been a little bit more difficult from that perspective.
How about for the average? Some of your people must be retired, high net worth individuals. They've got this asset, their house. And maybe they'd like to either move up to something better, or maybe they want to downsize. The kids are out of the house. There's no reason to have the house. Mortgage rates are high, and it's got to probably impede the ability to either move up or to downsize. What are you hearing about that? We're
in this little, quandrum of, some of us still have interest rates that on our house that may be 2.75, 3%, right? And you have this emotional side like, hey, I don't want to sell because of the interest rate. And then I move to something that may be, 6.5, and 7, right? And so then you're like, well, if I sell here, now it's the type of house that I can get is so much more. I mean, I saw a report just the other day that house prices are at an all-time high, right? And so if they're an all-time high and you're trying to either move up in a house, you're paying more, or if you were to move down, you're paying more, and you may be giving up an interest rate that you may not ever see in our lifetime again, right? So the emotional side of that is very hard on a lot of clients too, right?
It is, and it for many people, the house that's the nest egg. It may be the most significant asset that they have, maybe even bigger than the stock market in most cases. So not being able to monetize that in any way, whether it's to refi, can't do that obviously, can't sell and move up, can't sell and downsize. It's an impediment to the economy. We're almost out of time. Rusty. But what I'm learning here is there's such an immense amount of information here. We're gonna have to set larger time blocks. We're gonna have to do it a lot more often.
Yeah.
Is there anything that you wanted to talk about before we go?
I just want to tell you how thankful I am for you to have me on your show. I mean, again, I see you on Fox. I know with Belpointe, we have a great ecosystem here with advisors. We have a lot of different, as far as just you're a chief strategist here. We've got so many different companies. We got so many different initiatives. I'm proud to be associated with Belpointe, and we have some of the best minds out there. So to be able to spend time with you and to share some of your thoughts, where people see you on Fox News, and then I'm able to talk with you here in Greenville, South Carolina, and we have clients all over the country. But to be able to do that, it's just quite an honor, David. So I really appreciate you having me on here.
It's firms like yours that make Belpointe what it is, and the ecosystem that it is. We all feed on each other, and I got to tell you, it's been a real pleasure. I hope we can do it again real soon. Thanks for being on, Rusty.
Absolutely. Thank you for having me.
And that's it. I hope you enjoyed the show. We're going to have Rusty back again real soon. Don't forget, if you want to learn more about the Money Runner, go to the Substack site, DCNelson123 at substack.com. I'm David Nelson, and this is the Money Runner.